going on, Founder University? On today's episode, we have Matt Cohen. He is the managing partner and founder of the VC firm Ripple Ventures, and his story is really inspiring for anyone in the tech space or in the investing space. He had a career in banking. He took a high flyer and put $50,000 of his own money into a friend of his business that had no revenue, barely a product at the time, rolled that into a huge win, and then gambled on himself and left his big comfy job and started his own VC firm, which now Ripple Venture is one of the most successful and well-branded early stage investment firms here in Canada. And he shares everything about the VC world, about what he looks for in companies that they invest in. And if you stay to the end, we even go through a little bit of a game of playing overrated and underrated with things that are hot in the tech community right now. So I learned a ton from the episode. He's super insightful. He sees more companies than anyone else that I know. So hopefully you gain some great insights from this episode and can apply it in your business later today. Thanks for listening. Thanks for watching. We'll speak soon. Matt, what's going on? Long time no see. Good to be connected.
Good to see you, buddy. Thanks for having me.
Yeah, I'm excited to have you on and have someone on with a little bit of a different perspective, not just a founder, but someone who runs a company and is a founder, but works with a ton of founders. So I'm excited to have a conversation and pick your brain on everything in the tech world and funding and VC and all that kind of stuff. And just have a conversation and learn from you, the master who sees more startups than most people in the world.
Okay, as long as I'm not just a podcast guy, that's perfect.
Yeah, exactly. Well, you're multiple things at once, founder, investor, podcaster. And I'll give a little bit of context to the listeners, at least my context of who you are and your backstory and your VC firm Ripple and how you guys came to be, because we have a very unique background and connection. So for anyone who's listening, Maddie is the founder and managing partner of Ripple Ventures. You're a VC, early stage VC firm here in Canada, investing in SaaS companies across the US and Canada. But I'm more impressed with your backstory and where you kind of came from and how you started this business. And the backstory and my perspective on it is you were always in corporate banking. I think you worked at RBC for multiple years and grew up in the corporate banking world. And I guess when you went to bed at night, you dreamed of starting your own thing and a VC fund and going out on your own. And while you were there, you actually invested in the company I was working at. And you were an early investor, probably in the first check or first 3 checks in a company called Turnstile.
Very first check.
There you go. Number one. Do you have that? Hopefully you have it signed and framed up.
Honestly, there was no bank account to even deposit the check into. There was no company that existed. It was just Devin and a crazy idea riding around the city of Toronto.
And it seemed to work out, which is awesome. So there you go. First check into a company called Turnstile. Long story short, I was a salesperson there. We were acquired by Yelp for $20 million back in 2017, which seems like an eon ago. And I guess you parlayed that into your sort of seed funding, or at least your seed encouragement to go out and start your own VC firm. And it's been, you haven't looked back since then, which has been exciting. And from my perspective, you're one of the most well-respected and recognized brands in Canada for early stage VC. So I've always been impressed and truthfully proud that you sort of parlayed that early success into like taking the leap of faith into entrepreneurship. And then you sort of ran with there and built a beast. So that's my context on it.
Yeah, for sure. I'll try to fill in a couple of the blanks that you missed on, but thank you for that. And I appreciate it. It's always fun to have people that you backed early on, with your first check into a company like Turnstile, see them go on to do things like you. I think that the little Turnstile mafia that we've created have spawned a ton of great people. And that's why I named the firm Ripple Ventures. Truly, it was because I saw, and I thought about this early on, like those little bits of, capital or support or late nights working in the offices with the team early on, those little decisions had huge impacts and huge ripples throughout people's lives. We have friends that went on and did their MBAs because of, the exit to Yelp. We have people that went on and, went out and built great companies themselves, like Nick Chepswick at Untold, which was the very first check that we wrote out of the first fund. And so, a couple fill in the blanks. So I spent a decade of my life actually working in capital markets and finance in New York and Toronto for the Royal Bank of Canada. And those were very formative years for me. I never really wanted to be in banking. I think I was just really obsessed with like markets and all public markets for the first part of my career. And that really set me out on this course of understanding, how companies were looked at and invested in on the public side once they'd already gone public. But when I was living in New York and I started seeing things that were happening in the private side, there was the early days of Silicon Alley, they called it. So it was the New York version of Silicon Valley. And you had companies that were kind of popping up left, right, and center in New York. And this was 2010, 2011, when I was living there after the global financial crisis. And I was hearing and reading about these companies, but I was never able to kind of understand like their first few years of existence. And so when I moved back to Toronto and I was graciously introduced to Devin before even Turnstile was an idea, I really got obsessed with how do companies actually get started. Like I didn't know what venture capital was. I couldn't even spell VC, honestly. I had no idea. It was public markets, a little bit of private equity because there was like the LBO and M&A space that I lived in every day, but there's no venture capital understanding. And when I started learning about all these things of how companies were either started with like software and then they had some early customers and then they had some larger customers and then they eventually were acquired, that made no sense to me. So I had to live the experience myself by putting my money where my mouth was. And so I wrote the first check to start the business with Devin and Matt and Chris for $50,000. That was it.
Crazy.
And it was my version of an MBA, and spent a lot of nights and days working, around the business, helping them find some early customers. Brought Ryan Freeman in, who I knew growing up as an early employee, and just things like that, like being as much hands-on as I could. And that eventually led to the start of Ripple Ventures. But I'll never forget, I was very scared to do it. I wanted to prove it to myself that I could do this without taking on the pressure of doing it with other people's money and commitments. And it was Devin, the founder of Turnstile, who pushed me to start a VC fund because he said, I'll never forget, he said, I wish we had somebody like you as a VC fund that backed us from day one. I was just an angel at the time, so I didn't have like the platform of what a venture fund like ours now has. But he's like, I wish we had you as a venture investor in our very first company, because we would have been so much more successful and we would have had so much more support to lean on. And so there are more founders out there that need you to do this for them, because I saw how much it helped us when you were just a small angel. Could you imagine what it would be like if you actually had the capital and the team and the support and the platform behind you to support us? How much bigger of an outcome we could have had.
Yeah, that's it's a wild story and an amazing outcome. And I guess for you, it's interesting to hear that because now obviously you have a platform, you've been in the industry for a long time, but I guess that first $50,000 check, did it actually serve you a benefit because you didn't have the structure and the process and the team to do it? Or was it actually beneficial for you to sort of cut
Totally.
that check yourself and get your hands dirty?
I
Or
mean, there's nothing better than learning by trial, right? And learning by failure. I've had a lot of failures over my life, and I look at them as like not failures, just lessons. And like, I'm so happy that I had them. In the times they sucked, losing
yeah,
25, 50K, 100K here, it sucks. And you beat yourself up over it. But if you don't remember them and you don't build on top of them, you'll never be able to avoid them the next time. And so, yeah, of course, I'm happy I didn't have a fund and I didn't just walk into like, my parents' fund one day and be like, hey, I'm a partner now. Let's go to work. Like
yeah,
that is such a great thing to not have. Nothing wrong with that with people who have that, but you're just skipping tons of the breadcrumb following, in my opinion, that will get you to be a enduring investor, which is, let's face it, venture is one of these games where you don't know if you're good for a very long time, but you'll know if you're bad pretty quickly,
yeah.
which sucks.
It's a long-term play for sure. And you have to have that endurance to stick it out. And you're going to have more losers than winners. And I'm sure that's an emotional roller coaster because it's
Totally.
either your money or your investor's money, which is never fun to lose money, whether it's coming out of your pocket or someone else's. But you have to have that sort of long-term focus and mindset associated with it. And for you, I guess early on, because I'm trying to put myself in your shoes, like if I was cutting a check for 50K, whether it was when I was earlier on in my career or today, I don't part ways with my money very easily. Was there a certain like trigger or idea or sort of a mindset that you had of like, okay, I'm going to cut this check for 50K into this guy, Devin, who has this wild idea, maybe no revenue or a little bit of revenue at the time? Or what was your mindset around it? Because I don't know if I would be able to talk myself into it.
Honestly, I I'd grown up around entrepreneurs. Like my dad ran a small business, so I saw the ups and downs of that. I had a brother who was running his own small business, and I had my other brother who was running finance. He was a wealth advisor, and obviously I speak to them all the time about decisions that I make, whether it's buying a house or making investments early on. And there was one mentor of mine who was my boss actually at RBC, who was a very close advisor and mentor. And I said, like, hey, I'm going to write this check into this no name idea company. Like, is this stupid? Am I dumb? And he's like, well, let's just play this out. If you wake up 10 years from now, are you going to miss the $50,000? And I was like, probably not. It's just going to make me work that much harder. He's like, but if you don't do the check and it does work out, are you going to miss the fact that you didn't write that first check? I'm like, yeah, I probably will. And he's like, and if you lose the money, you're going to make it back eventually. And if it doesn't work out as much as you hope, think about all the lessons that you're going to learn because you're being bought in and exposed to this journey from the very beginning. And it was my MBA. That was it. It was like, how do I figure out how to get exposed to the very beginnings of a business building experience without having to take, 2 years to go do an MBA and spend $250,000 to do it. That was like the mental math I did. I think it's very different though, writing $50,000 into a company that you have no say in, like none. Like, let's just say it's like a Series A company. And they've been around for a couple of years, they're doing well, and you're just writing a 50K check as an angel who doesn't have a lot of money. That's scarier to me, actually, than it is writing a check into someone you're going to be working alongside and having a huge say and impact on. Is a lot easier because I think you can control a little bit, maybe the destiny a bit better. You feel like you have some control, and that maybe is a little bit better. It's like driving a car from the back seat. I think that'd be a lot safer than having nobody driving the car at all and just sitting in the back seat with no seatbelt. I kind of just close my eyes and hope for the best, and hope that either I would get a great life lesson out of how to build a company that didn't scale or succeed, or one that did, and it would change my life, and it did. I think like the other lesson it taught me that I really wanted, which I never had, which was how not to be emotional daily around buying and selling investments. I think being a public market investor for so long really warped my brain around how liquidity was a feature, not a bug. Meaning like you could take advantage of liquidity anytime. Like, hey, you're up, 5-10%, sell. And if I just never looked at the stock or never just thought about like taking that quick win, how much better off would I have been is probably a lesson I needed. And this was a great way to get that lesson, because once you're in, you can never get out until it's, either a zero or it's a great outcome. And that honestly was the best lesson that came out of it. Cause there were nights that I would be like, oh, like we could sell this thing for like $4 million. And I'd be like super happy, it'd be like a great, 10x return for me or something. Cause when I invested, the company was nothing. I was like, oh, if we sell for 10 million, this would be like a 20x return. And then, we sell for 20 million in cash, 30 million, almost Canadian. It's life-changing. But it was hard waiting, waiting. It was 4.5 years, not that long. Since I wrote the check in September 2012, and we sold officially. And I think it was November LOI, and then closed in February, I think. And that was, it was a great lesson for me. So I'm glad I also did that as well. An unforeseen lesson, but a great one.
Yeah, for sure. It's a good point, because I'm not from the investing world at all, but there's so many different emotions and expectations. You're right. In the public markets, you don't have to have longevity if you don't want it. You can go the Buffett route and value invest and do it for a long time. You can go the trading route and just flip flop every single day. But VC sort of has to go the long term, and you have to ride it out. And that could be good or bad. But if you don't have that mindset initially, it's going to be bad no matter what, because you're signing up for the long game. And I think you said it earlier. It's like, you have to know what game you're playing, and you have to know the rules of the game and set yourself up for success, because it is a game and it does have certain rules if you want to play it the right way.
I tell our founders, I tell our team this all the time, like the most important skill set beyond being great, pickers and great networkers in venture is the ability to control your emotions on the good and the bad. Because you're going to have great news one day about one company doing really well and fundraising and hitting their stride, and another company blowing up the next day. And if you can like take charge of your emotions on the good and the bad, you're going to have a much better chance of actually resolving bad things when they happen, because you're not going to come at it with like a visceral reaction. And when things go really well, you're not going to be incredibly overly optimistic and confident in your own ability, because it's going well, and realize like this isn't something that's going to last forever, or, we shouldn't take this moment for granted. Let's figure out ways to kind of maintain this consistency for the long term, not just like enjoy this 1 second of like, dopamine hit before
Yeah.
things, hit the fan again.
Yeah, exactly. It's very easy to say. It's so hard to do, and I think the only way you can do it is by learning and doing it yourself. And for me, as like a career salesperson, that was 100% early in my career. I would have a week where I wouldn't book a demo, I wouldn't close a deal, and I think I'm irrelevant and the worst salesperson in the world. And then have a week you close 3 deals, and you're sort of on this high. But the ones who are consistent over time are the ones who benefit the most of
Yep.
it. And transitioning a little bit, because I'm really interested to get this take on. I like to speak to a lot of founders of early days. Is like, if you told me to go start a SaaS company or go start a service company like I'm running right now, I would know what to do on day one. If you told me to start a VC fund, I would be lost. Like, what does that even look when you say, okay, I'm going to start a venture fund? Like, do you just start banging on doors and try to raise money? Do you try to meet cool founders? Do you have to go through huge red tape to sign up and try to figure out your regulations and stuff like that? Like, I personally wouldn't even know, but what are the first month, 3 months, 6 months look like when it came to actually starting Ripple?
Well, the good thing about anyone starting a venture fund now is there's so much information out there on kind of how to do it. There's podcasts, there's, newsletters, there's tons of like books on it probably. For me, it was a little bit of like putting myself out there to learn as much as possible. So there were three things I had to figure out. One was like, what is the structural work that needs to go in? So sitting down with like a friend who can provide some really good legal counsel and support is really important. Having a good business minded lawyer is awesome and really helps kind of calm your nerves of like all the red tape you have to go through. So that's the first thing I did. The second thing was speaking with other GPs at other venture funds about what their journey was like and things that they learned along the way that you should avoid, or things that you should really focus on. And then obviously you have to raise capital. It's a little bit of a chicken and egg, right? Because you're going out raising capital, but then you have to go find investments to put it in, right? John Love, the founder of Kingset Capital, who was on my podcast, had this great line about how private equity venture capital is this continuous flywheel of terror. The first thing is you have to go out and raise the money. That's terrifying. The second terrifying thing after you raise the money is you have to go invest the money. That's also terrifying. You have to make the company successful. And then lastly, you have to return the money. And that is also very terrifying and very hard to do. And then once that's all done, you do the whole thing over again with a new pool of capital and a new set of investments and a new way to return capital. So it never ends, the terrifying wheel of venture capital and private equity. So once you overcome that mindset, you have to go out and raise capital, and you're asking people to give you capital for 10, 15 years that you're going to invest, and you're going to promise them that you're going to return more than they gave you over that set period of time. Now, there was one hack that I learned about through my journey, which was I had already been fortunate to build up my own portfolio of investments as an angel investor. I had the exit to Turnstile. I also had some other exits along the way as an active angel investor that provided more liquidity for me. And so I was already building my own angel portfolio before starting the venture fund. And one of my very first LPs in the fund suggested that instead of starting with a blank pool of capital with no investments, that I should roll two of my best and biggest angel checks into the fund to show that there was something in the fund, as an existing investment, so that they could look at it and be like, okay, I'm not just buying nothing. I'm buying, a couple investments. But the problem was I'd made those investments almost a year prior to launching the fund, and they were doing quite well. And they were probably worth more than I invested, but I made the conscious decision to roll them in at my cost, even though they were probably worth more. And that was a great decision as well. And investors really gained a lot of trust in me. They got a lot of respect for what I was doing. And sure enough, that first company I rolled in was On Call Health. And that company was the first company that we sold. What was it? 2019, sold in, I think it was 2022, maybe. I think something like, so it was like 4 years. It was crazy. And so, yes, I lost a lot of personal upside because of that investment going to the fund. But I gained a lot of respect, I think, from our investors and helped carry us through that first fundraise and on to the next few funds.
Yeah, it's a huge competitive advantage, but I think for you, like you get all the credit for signing that money over essentially. Like you had that money earmarked, and I'm sure that wasn't easy as well, but it buys insane amount of goodwill. And I guess if you believe in what you're building, and that goodwill will carry two, three, five, 10x
Exactly.
more than what the money is, then it's
Also, who knows if On Call would have been successful if we didn't have a brand name like Ripple eventually being supportive of it. If it was just Matt as an angel investor,
yeah,
yeah, I definitely had some help along the way. But I think it helped also not just ourselves, but I think it also helped Nick and On Call having a brand name firm behind it rather than just an angel investor as well. So who knows what would have happened? I'm not looking back and no regrets. But it was definitely a decision I made that not everyone has that, ability to do. And I'm very glad I did it.
yeah, for sure. It's amazing. It's amazing that the two early returns were both
Yeah.
Turnstile Mafia, and also in that 4 year window, which I'm sure on in the scale or the average in the industry is relatively short
Very.
time frame to
Yeah,
go
most
through
exits are
Turnstile.
7 to 10 years, probably, if not
Amazing.
10 or more for real big outcomes. These weren't massive outcomes, so that's why it's probably a bit shorter,
Yeah.
but they were still very meaningful for myself personally and for the fund.
Yeah, it's insane. Very excited to hear the Turnstile Mafia is still strong, and hopefully they give you more dividends down the line with other founders and other companies launching. So they know
Still
who to
paying
call
off.
first. Reach out to Ripple first, and they you got the good luck chuck when it comes to Turnstile. But
There you go.
from the VC world, I guess startups in general, I wanted to get your take on the sort of transition that has happened over the last decade. Let's call it from like raise capital, raise rounds, spend money, don't think about profitability to now, and I guess you correct me if I'm wrong because this is your world every day, is like people are way more conscious of chasing profitability and turning a profit early on and spending very cautiously. Like, is that still true, or is that evolving every day, or what do you think is like the core trend for companies nowadays when it comes to growth and using VC capital strategically?
I don't think profitability would be the first thing that people would strive for. I think it's definitely a goal, but it's not the goal. I would just change it a little bit and say efficiency is probably a lot more of what people are thinking about. And that comes in a different couple ways. One is around speed and efficiency. So, like, are you growing fast while also consistently delivering on the capital that you put in? Is coming back in terms of growth and revenue? Two, are you growing faster than the headcount that you're adding to the business? So we have companies, obviously, we lead pre-seed fundraisers for companies at the very earliest stages, sometimes pre-incorporation, obviously pre-product and pre-revenue a lot of the time. And we're the first check in with $500,000 to $1 million US. So we're trying to get them to be, generating revenue. But once that revenue engine does turn on, do we start to see repeatability month over month? And what we're saying to companies is if you can start to add revenue month over month, let's do this in a targeted way, right? Let's make sure we know our ICP. Let's make sure we know the customers we want to go after next. And the pipeline is starting to turn over and start to close. And we're also aware of if we do raise the next round of financing, we have a clear understanding of where we want to put that money next, whether it's in the go-to-market side, whether it's on the product side, whether it's on the engineering side, things like that. There used to be this like first invest, then investigate sort of mindset where it's like you'd raise the money and then you'd figure out where you want to put it and like hope that everything worked out because money was flowing freely and things just did work out.
Yeah.
Where nowadays it's a lot more scientific, excluding some of the AI stuff. But we have companies that have only raised like $500,000 or $1 million, and they've already eclipsed in annual recurring revenue what they've raised from investors, which is unheard of.
Yeah.
In the first fund that we raised in 2019 or so, we were seeing a $5 million capital investment into a business like a SaaS company, and they would take a couple of years to get to $1 million of ARR. And that was pretty good. 5 million in and $1 million of ARR is pretty good. Now we're seeing, like I said, $1 million in or like 2 million in and 500 to $1 million in ARR in the first 12 to 18 months. Like that is really good. And that's because the tools available now obviously are incredibly cheap and incredibly good at what they do between the AI tools you can buy. Companies are way more focused on the problems and more targeted on much better like wedge problem use cases. And customers are much more focused on tangible ROI for the products that they're willing to spend money on. And if it does provide immense ROI, they're willing to throw a lot of money at that from a budget perspective. So that's really also something that we're seeing is helping our companies grow really fast. We've had companies, in 6 to 9 months since we invested, go from 0 to 3 large, customers to 500K in revenue to like a $5 million seed round.
Wow.
Because we know we can get to $3 million in revenue in the next 12 months. That's unprecedented from what we usually saw in the first
Yeah, for
iteration of.
sure. It's unbelievable to hear because usually it was like a couple 100,000 or a million in revenue, and you'd raise these big rounds with the hypothetical theory that you'll be able to get to 5-10 million in revenue. And
Right.
majority of companies never to get there, but now it's amazing to see that early traction and a lot more comfortable. But I guess from that side of it, do you find these companies are not as capital intensive? Like they're not looking for A, B, C, D rounds and not trying to build on this huge cap table, or I guess it's pretty industry specific depending on what you're building, because obviously the more money you raise, the more dilution you have, the less equity for the founding team and stuff like that. But are you seeing companies sort of stopping at a seed round or an A round and just sort of growing through efficiency, as you said?
I think there's different paths you can take. I just got off a phone with one of our founders, who's one of the ones I spoke about, which they raised very little capital. They've grown really fast, and they have a decision to make, not now, but soon, on whether or not they want to get to like 1 million of ARR with the capital they've raised, which is less than 1 million, less than 500, and then get to like 5 million just off of that, because they're basically profitable at that speed. Or do they want to get to 10 million even faster? And they need to do that by raising more capital, maybe acquiring some of their competitors, and then trying to get market share as quickly as possible. It really depends on what kind of founder you have and what they want to go for. And we don't really care, honestly. Like, yes, it would be great if they want to go down that, grow to 10 million fast and go do acquisitions. But you're right. It comes with dilution. It comes with, giving up shares in your business to acquire other businesses with your capital and your equity. And that's not something that, all founders are built for. So it really just depends. Yes, the venture is a game of outliers for sure. But I think in our world of where we invest so early, we can have really great returns in our funds, even if the company only caps out at $10 million of revenue, especially if they're capital efficient to get there, because we're entering in at like, $4, $5, $6 million post-money valuations in some of these businesses. So a $10 million revenue business that gets there in 3 to 5 years, it's still $100 to $200 million business, right? Someone, private equity or somebody, wants to buy that business if they believe it can continue to add, even 40% or 20% a year over year. That's great.
Yeah, it's
a $200 million exit is good for us.
Yeah, 100%. It's interesting you said like because the stage you enter, but my perception of VC is like everyone's chasing the $1 billion businesses. But
that's because the fund sizes have also gotten very big. So we've kept our fund sizes small, which allows us to have a lot more flexibility on the outcomes that we need to see, right? So you've seen the whizzes of the world, right? You've seen all those outcomes, but like, because the funds that invested in those big deals only returned like a third of their fund, it's not really going to be helpful to the LPs or even the GPs if they can only 1x the fund, because the fund started off as a $1.5 billion fund.
Yeah.
Right. So it's very hard in venture to do that.
The headline catching, those are the logos and the names that everyone wants to talk about. But when you pull the curtain back and actually look at the finances around it, it's better to be a pre-seed investor at 5 million that exits for 50 million than being whatever, one of many in these $1 billion rounds, and they sell for whatever, 2-3 billion or whatever the companies.
Yeah. Look, it's a factor of how much you own of the business, right? At the exit, that makes a difference. And because we own 10% or so of our companies at the beginning, let's say we get diluted by 50%, which is average, let's say, across a couple fundraising rounds by the end. So we're left with 5%, that's including dilution from the rounds and ESOP top ups and things like that. So 50%, we're 5% at an exit of a company that sells for, 200 million. It's 10 million bucks, right? For us, that's great. That could return like half a fund. And so you don't really need to add up like multi-billion-dollar exits for a fund that's less than 50 million to be able to see some really good alpha for your LPs and for the GP carry.
Yeah, amazing. And it goes back to the game theory. It's like you're not being SoftBank, and you don't need to be SoftBank. You can play a different game within the VC world, and if you,
Yep.
as long as you have sort of that focus and mindset on it, then the returns are going to be there for you and all the LPs.
And I think also founders are appreciating that now. They used to not really think about it, right? They never usually questioned a fund size or anything like that. They were actually, just caring about how much capital they could raise for themselves. Now it's like, how do I fit into the broader portfolio of companies? Because there's also that signal risk, right? If you take money from, Insight or Sequoia on a seed round, which is like tiny, tiny checks for them, even if it's like a couple $1,000,000, it's a tiny check for their multi-billion-dollar multi-stage fund. If they don't do the A, it's bad, right? That's signal risk. That's really bad. If you only make it to the B and then sell, that also might be not great for them too, because like it doesn't move the needle for them. So there's a lot of misalignment sometimes when you have those bigger funds coming into companies at the earlier stages. So what we try to optimize for is when we write our first check, we try to surround ourselves with really good strategic angels or other smaller pre-seed funds. At the seed fund, where we typically write our pro rata reserve, but we have another firm lead the seed, which is a pretty hot market. We try to find the best seed managers who are either like ex spinouts of other great GPs, ex operators, or very niche specialists in the areas that we're building or the companies are building in that we want to partner with, and get them to do a lot of the work with us to get them to a Series A and beyond. And that works really well for us. So we don't usually have like the biggest multi-stage funds coming into our seed rounds. It does sometimes happen, and those are like scout checks to lead the A, but we don't rely on that investor to be the only one to write the A round. We can actually have other investors as well do it. So we're trying to understand the game that we've signed up for and get our founders to understand that as well. And that really kind of comes down to transparency throughout the investment process.
Yeah, it's refreshing to hear that it's not a chase to just get the biggest check. It's about the right check and the right relationships to do that.
Yeah,
And
it's a
I'm sure that's
marriage,
been
10
an
years.
evolution. It didn't start that way, and now it's good to hear that it is. But I'm sure it's a wildly competitive industry. But sounds like you have great relationships with other investors and advisors and stuff like that. You plug and play into the business. And for the business itself, like Ripple as a standalone business, like what is the structure? Is it just you and a bunch of analysts? Like you have a lot of other partners that are involved day to day? Like what does that actually look like? I don't even know the inner workings of a VC fund.
Yeah, so a VC fund, it has like kind of three entities that would make up a venture fund. You would have the general partnership, which is usually just an entity that captures the profits from the carried interest portion, the 80-20 split typically from LPs and the GPs. You have the limited partner fund, which is each fund has its own limited partner pool of capital. So every time someone says we've raised fund 2, fund 3, the actual nomenclature is like Ripple Ventures Fund 2, Ripple Ventures Fund 3. And those are 10-year to 13-year fund lives. People commit capital over that time period, usually called within the first 3 to 5 years, make investments, and then you harvest those investments and pay them back to your investors with a set, preferred return or something. And then you have the management company. The management company is what gets paid those 2% annual fees over the life of the fund to pay for the operating cost of the people, your overhead costs, whether it's an office, whether it's like the events you're throwing, whether it's your software budgets, you got to pay for all the software tools that we use. Our software budget is actually quite high, and anything else you have. So the management company is the operating company for a fund. And that's where our employees work. So we have got Naz, who's our senior associate. She's incredible. She runs a lot of our corporate development relationships, our co-investor networks, a lot of our programs as well. And then we have Katie, who is our associate as well, who runs a lot of our Ripple X programming, a lot of our events and platform initiatives, and then also helps obviously on due diligence. And both of them work on company, pipeline management as well. And then my partner, Dom, who's based in Vancouver. So we have a West Coast office and a Toronto office. He's been with me since day one. He was an analyst on Fund 1, a principal on Fund 2, and a partner on Fund 3. And so he's now a partner, and that's sort of the graduation that we hope everyone gets to one day. And the role of the fund is to, one, source investments. after raising capital, which is a very hard thing to do. Like we see 10,000 companies a year. We probably only meet with like 1% or so of them in terms of like full teams. We have a very rigid process for when pipeline comes in, goes through like the team and then the partners and then due diligence and all that. We've got like a weekly, stand up Monday meetings. We have impromptu partner and full team meetings. We have a lot of events that we do across the country in the US and Canada. That's really about building our brand, building our network. We have our own podcast, Tank Talks, obviously, to help create a bit of a media goodwill and brand with our followers and community. And then we've got our LPs, right? And that's a long-term relationship that we're building over decades. And those are existing LPs and potentially future LPs. They could be made up of family offices, institutional investors, financial institutions, endowments, things like that, pension funds. So you're always trying to manage like many relationships at a time. Like your CRM is your source of truth, as you know, in sales. And we have to be really good at managing that. So sales does obviously play a huge role in that.
Yeah, 100%. Well, you have those 10,000 companies that are coming in the door. And I wanted to pull back on that because I think a lot of people who are going to be listening are founders or thinking about starting a business. But for you, when you and your team look at those 10,000 applicants or submissions or decks or whatever it may be, what is it that makes the 1% stand out and the ones you want to have meetings for it? Like what catches your eye?
Well, it's not like a one size fits all kind of thing. So on our website, rippleventures.com, we're very transparent what we're looking for, what our thesis is, the areas we focus on, the stage at which we invest in. So first you got to filter yourself out from that if you know that it's not within our sweet spot. Once that sort of happens and it does mark, a lot of the boxes for where we care to invest, you usually have an associate and maybe a partner join the first intro call. And that's really just to get to know the team. But the two most important things that we care about when meeting with a company, if it meets all the criteria for where we invest and sort of the stage and timing, is who are the people dedicating their lives to building this and what's the problem they're solving. We don't care what the solution looks like. We don't care so much about the technology and the product per se at the stage that we're investing. We want to know that people could build the product, but we really care about the problem that they're solving. How do they come across this problem? Why are they so confident that it's a problem that needs to be solved now and there's urgency around that problem? How big is the problem, obviously? And then our team goes off and validates a lot of it ourselves. So we talk with other, firms, we talk with other industry experts, we put our own research and heads together and discuss it, whether or not this is exactly what we believe it is, not just taking the founder's word for it in terms of what they say the problem is. And once that validation is done, then we really get into the nitty gritty of like how they're going to solve it, how they're thinking about building their first MVP, how they're thinking about the team it's going to take to build this and the cost it's going to take to build it, like getting into that sort of hypothesis discussions. And then whether or not there's a deal to be had for us to be a partner for this. Because like I said, from the very early, part of this podcast, with Turnstile, once I was in, there was no way of getting out. And that's the same thing with all the investments we make. Once we're in, we can't really get out. And so we need to know that this is the right team to work with us and they want to, let us work with them. We also need to know that there's a path here to seeing some early signs of traction. Product market fit is a bit farther away from where we typically care about investing. But yes, we want to get there, but we know there's a lot of twists and turns that have to go along the way. And then we really want to pressure test the founders, through asking them, the strengths and weaknesses about their co-founders. We want to understand exactly how they think about the competition and the market, and also their vision. Where do they want to see this thing go to? It doesn't have to be something they need to execute on near term, but if they don't really have a vision of where they think this thing will be in the next like 4 to 5+ years, that's also a problem for us as well, because we know that there's going to be a lot of twists and turns along the way in building the business. But if we know what their vision is from the beginning and we align with that, that gives us hope that there's a way to get back on the path to getting to that vision, even if there's a bunch of roadblocks that inevitably will happen for sure during the process.
Yeah, 100%. It sounds like there's a lot of heavy lifting up front to make sure it's a good match for both sides, because as you said, once you're in, and you want to make sure it's going to be a healthy relationship, a beneficial relationship to both sides. Because it's interesting, and speaking to a couple of people on this podcast, I've had people who've gone through YC and they're like, yeah, it's a 10-minute interview and YC pulls the trigger and does it. But I guess if you're doing it at such a scale, you put a lot of feelers out there, and you got big funds, you can make it happen. And I guess every VC firm has a different approach to distributing their capital, but that will work for some people, and that will be beneficial to some people, and it'll be bad for others.
Yeah, YC, as great as they have been, and in terms of picking winners, they've somewhat distorted the world of like early stage venture investing, especially for like early stage funds like us who are really hands-on operator focused over a bit longer period of time. And that's something that we try to explain to founders. Like some companies we invest before they go to YC, and then some of them we say like, if you go to YC, we probably will not invest. Yeah. So for some companies, it just does. They don't need to be. They don't need to be told what to do, and that's okay. Like there's a lot of companies that can just take capital, deploy it perfectly, and just have a great outcome, and that's great. But the little secret about YC also is that like 80% of the companies don't succeed, and so it's really hard to pick off the best 20% as an early stage venture investor without obviously paying a huge premium for those as well if you're pretty confident in that. And we just don't have, one, the luxury of doing that, and two, it doesn't fit our model, and we're going to miss out on some really good outcomes because of that. But we do think for the outcomes that we are striving for and the partners that we want to work with, because this is a human problem that we're solving for at the end of the day, we believe it's the best strategy for our fund, and we'll hopefully deliver the best results because of that. And so we're just playing a different game than some other funds out there.
Yeah, it's working. Don't change it if it's already working. So whatever you're doing, keep going
Don't
that
count your
direction.
chickens till they hatch. It's still a long journey for us, but thank you. It's been good so far.
Exactly. Good so far in the journey. So we'll finish up here. I wanted to throw a couple rapid fire areas or industries to get your take on and sort of get your snap reaction if you deem them as overrated or underrated. Maybe you can give a little bit of context on them. And some of these things we hear about all the time and are on my mind for sure, but I'd be interested to get someone who has the capital to invest in these companies, what your take is. What's your take? Over or underrated AI wrapper companies?
The ones that have been created in the last 3 months, or the ones that have been created in the last 3 years? I think the ones that were created in the first 3 years.
In general, it seems like these are popping up left, right, and center, or people are just building on top of
LLMs. I think they're underrated from a standalone business perspective. I think they're overrated from a venture backable investment.
Fair enough. That makes sense.
I think there's a lot of wrappers that will be self-sustaining businesses that can do several million in revenue, but don't need venture capital dollars to get there.
Yeah, that makes sense. So the back end is built or has the LLM to plug into, so they can just scale and grow profitably, hopefully. What about vibe coding? Overrated or underrated?
I think it's underrated for now. We have a company called Pika OS that is an agentic AI tooling infrastructure player that is riding the wave of vibe coding. I think it is an incredible time to see what's coming out of a lot of the vibe coding applications. But I think it's going to dwindle away over the next couple of years and something better will come out of it. But it's an incredibly exciting time to see all the tools that are being built. It's just going to be really hard to pick out the winners from that vibe coding area. And so I'd rather be doing the picks and shovels investments in vibe coding, which is what we've done with Pika OS.
Nice. Makes sense. Remote work.
Depends on the industry. I'm not a huge proponent of full remote work. I'm shocked to hear some companies are still full remote work. I would say hybrid is probably, if you had to choose like remote work or full in office, hybrid is probably the best, 3 days a week. But I'd say a lot of our companies have all gone full back to office and they love it. In fact, some have signed new leases. A lot of them have, had their space overrun with demand for people who want to come back to the office. So I'd say like in office is where people are really focusing their attention on now.
Yeah, we see a lot of those clients as well, or like an 80-20, 80% in office, 20% out.
And that 80% is like super packed.
Yeah, 100%. And what about founder personal brands? Overrated or underrated?
Underrated. I think it is important for a founder to have its own brand and following. I think that a founder embodies the culture that they're trying to set at their company, and it'd be great for founders to speak about that. I think that there's a little bit too much hype around like focusing on your brand and not focusing on your business. Like, talk the talk, walk the walk. I get it, but like you got to let your business do a lot of the talking if you're going to be a successful and looked up to founder. I wouldn't say like Warren Buffett, cared about his brand at all. He cared about his companies being successful and his fund being successful. But inherently, because they were successful, he had a big brand and he had a big following. So I think like you can't have one without the other. You can't have a failing business and a good brand because they just don't go together. They have to hold up. It's like, does Nike have a great brand because they're good at branding or because their products are really great and people want to keep buying them and therefore the brand continues to grow? I think it goes hand in hand.
Yeah, 100%. And now it's just become easier and easier to distribute and build a brand, which seems to be very common in B2B. And yeah, if you have that relatively free distribution channel to help you get more clients and more exposure, then it's a huge benefit. And
it's great for recruiting. It's good for partnerships.
yeah, it's going to be more and more popular across the board.
Just
And
not as a distraction though.
Exactly, 100%. Might get to build up too many big egos with the founders could be an issue. Last thing here, just to get your take to stack rank. So when you and putting in your VC brain and eyes on this, like when you're going to look at an investment, stack rank, I guess these four things when you look at a company: the founding team, the product, the industry they're in, or traction/revenue.
So 1 is founding team, 2 is industry, 3 is product, and 4 is traction.
Founding
I think
team
it's
is
easy
a big 1A above everyone else, you would say?
100%. Yeah. I mean, there's nothing, a great founding team can solve almost anything. And if they are in the wrong industry, they'll quickly pivot. Like we have one founding team that completely pivoted into a brand new industry and they're doing great. But that's because the founding team was really strong to be able to recognize their weaknesses and recognize the timing was wrong in their first industry and now are now picking off a different industry. But if you started with like product, let's say, or traction, but the founding team was weak and the industry was okay, you're screwed. As soon as like trouble hits, you're screwed.
Yeah.
Because they're not good enough to pivot. They are too weak of a team to recognize their own weaknesses, and they can't restart from scratch at zero and rebuild very quickly. We had, VoiceFlow was an example of that, like an incredible founding team who had to pivot overnight when LLMs were launched and the entire conversational design industry was basically put out to pasture. And they had to rebuild their entire product over like a weekend or 2 weeks. Wow. That was because they had an incredible founding team, an incredible CEO and CPO and CTO and CEO that they were able to do that.
Well, people over everything. So it's a good way to end it off. And from the master himself, I appreciate you giving a lesson 101 on VC and how the world works and all the success that you've had, which, as I said from the beginning, I've always been impressed and admired what you've been able to do. And building some great Canadian and American companies through investments, but also partnerships and advisory and helping them grow. So appreciate the chat and always good to catch up. And I'm sure I'll see you around soon.
My pleasure, Dan. Congrats on launching this podcast and this initiative to help other founders out, learn from all the things that you and all your guests have done. So kudos to you on getting this going.
Thanks, buddy. Appreciate it. We'll speak soon. Have a good one.